You are tuned in to the 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here. We do strategy. 5 minutes on the clock. Let's get to work. If you noticed a silence from this desk over the last 72 hours, understand that in the theater of economic warfare, silence is often a tactical necessity. While the masses spent their weekend drowning in the noise of speculative headlines and reactionary social media cycles, I have been calculating the drift. When the signals become blurred by high-velocity volatility, the professional does not guess. We pause, we observe, and we wait for the data to settle so we can strike with precision. This morning, the fog has lifted, and the reality of the market is far more complex than the Friday closing bells suggested. We have a great deal of ground to cover to reclaim the signal from the weekend's chaos. The news today is defined by a massive divergence in market sentiment. While the headline S&P 500 index recently breached the 7,000 mark, the real story is happening beneath the surface. For the first time in years, we are seeing a dramatic split. The equal-weighted S&P 500 is up nearly 6% year-to-date, while the tech-heavy, market cap-weighted version, the one most of you are exposed to, is barely scraping by at 0.2%. The weekend brought fresh anxiety as President Trump's administration signaled a potential 15% global threat tariff pivot in response to Supreme Court friction. Simultaneously, geopolitical tensions in the Middle East have pushed oil prices towards $70 a barrel on the back of potential military maneuvers. The markets aren't just moving, they are rotating, and they are doing so under the shadow of persistent inflation. Core PCE is holding steady at 3%, well above the target, signaling that the Federal Reserve, now transitioning under the influence of Kevin Warsh, is likely to keep the squeeze on for longer than your average retail investor can stomach. Why this matters is a question of structural integrity. For the past 3 years, your economic fortress has likely been built on the foundations of Magnificent Seven momentum and the AI hype cycle. That foundation is cracking. When an equal weight index outperforms a tech-heavy index by such a wide margin, it tells us that capital is searching for safety in boring sectors, energy, industrials, and consumer staples, rather than chasing the next LLM breakthrough. The 3-day data drift we just experienced over the weekend was a flight to reality. Investors are realizing that while AI might be a productivity miracle in the long run, it is currently a capital-intensive burden in the short run. We are entering a show-me phase of the economy. If the revenue doesn't manifest in the next 48 hours of earnings reports, the rotation out of tech and into broader value assets will accelerate from a trot to a gallop. You cannot defend a fortress built on a single pillar. You must diversify into the bedrock of the economy before the momentum trade evaporates completely. The hard truth is this. NVIDIA's earnings report this Wednesday is not just another corporate update. It is a referendum on the entire 2026 economic thesis. For months, the market has lived on the promise of the Blackwell chip cycle and the transition to sovereign AI grids. But the reality is that NVIDIA has been lagging the broader market for 90 days. If the AI bellwether misses by even a fraction, or if their guidance suggests that big tech is finally tightening the purse strings on capital expenditure, we will see a liquidity event that will shake the very foundations of the Nasdaq. Conventional wisdom tells you to buy the dip. I am telling you that there is no dip to buy if the structural demand for the underlying technology is being questioned by the people writing the checks. The grit of the situation is that we are overextended on a dream and undercapitalized on the reality of 3% inflation and rising energy costs. Hope is not a strategy, and a high PE ratio is not a shield. To defend your wealth in this environment, you must take the following 3 tactical steps today. First, rebalance your exposure to mirror the equal weight index. Reduce your concentration in the top 5 tech names and move that capital into mid-cap industrials or energy producers that benefit from $70 oil and domestic manufacturing tailwinds. Second, establish a geopolitical hedge by increasing your cash or short-term treasury position to 15%. The threat of a strike on Iran or a sudden Supreme Court ruling on tariffs creates gap-down risk that only liquidity can solve. Third, audit your credit exposure. With interest rates likely to stay higher for longer, any business or investment in your portfolio that relies on cheap refinancing in 2026 needs to be de-risked or exited immediately. The window for cheap money has closed. Don't get caught in the draft. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp. This program is for informational and educational purposes only. Economic strategist Vivian Thorne is not a licensed financial advisor. This content is not a substitute for professional financial, investment, or legal advice. Always consult with a qualified professional before making any financial decisions.